Hello, my name is Andrew Graffeo and I'm currently a third-year student at Cal Poly San Luis Obispo. Today's presentation I'll be using the Holt Valuation method to provide a comparative analysis of two conglomerates, Amazon and Google. Amazon is headquartered in Seattle, Washington and provides services to its clients through the use of internet and direct marketing retail. Google is headquartered in Mountain View, California and provides technology through internet and software services. Moving to the relative wealth charts, both Amazon and Google have had positive CFRI levels in the past decade above their discount rate. Both companies also appear to be showing the natural fade of CFRI levels with a reversion to the mean. Both companies have heavily invested into asset growth for which they have been rewarded for in their stock. When looking at sales margin and turns, Amazon has had much more consistent growth at about 25% a year for the past decade. This is different than Google, who's seen much more varied growth. Amazon has seen increasing adjusted operating margins, which has brought tailwinds to the stock as of late. Google's margins have been moving in the inverse direction, but are still significantly higher than Amazon's by 3x. Finally, Amazon has seen decreasing asset turns as of late, but are still very efficient when compared to Google. This is a sign that Amazon will continue to grow at a much more efficient rate than Google. When looking at each company's multiples, it is clear that Google is a much later stage company compared to Amazon in the natural fade process. Google is much closer to the industry median, while Amazon is significantly higher than its industry median in all three ratios: price to earnings, price to book, enterprise value to EBITDA. When looking at price tracking of the intrinsic value of both companies using the Holt Valuation method compared to its extrinsic value, we can see that the Holt Valuation method heavily overvalues Google and undervalues Amazon. Although the deviation levels are considered good with about a 15% spread from the extrinsic value, the bias of each company is 31% and negative 34% respectively. This is extremely interesting because when running a linear regression on the price of Amazon stock by the price of Google stock, you receive a 91% R-squared. This means that the two stocks are heavily correlated to each other's movement, but the Holt Valuation method continues to think that they will diverge. Although Amazon's current stock price is higher than its warranted stock price, future growth opportunities and its ability to expand efficiently makes Amazon a valuable growth stock for riskier investors. Google, being a later stage company in the natural fade, will provide consistent cash flows that the Holt Valuation method believes is undervalued.